If somebody called your agency this year and said, you're sitting on an R&D tax credit, I want you to hear the other side before you cite anything. Many agencies don't qualify, not because you documented it wrong, but because of what the law actually excludes. There's a real version of this credit for agencies. It's narrower than you're being told, and I'll show you exactly where the line is. I'm Craig Cody. I'm a former NYPD lieutenant, now a CPA, and a certified tax coach. My firm works with marketing and advertising agency owners all day long, more than 70 of them every month. Before we get started, if you own an agency or you hope to one day, subscribe to the channel. I post in-depth videos covering taxes, profitability, cash flow, agency finances, and the strategies successful agency owners use to grow while keeping more of their money. First, why is your phone ringing? The R&D credit is generous and there's an industry built on finding it. A lot of those firms work on contingency. They take a percentage of whatever credit they claim for you. That model rewards volume, not accuracy. I'm not going to tell you they're all bad. I will tell you that the person being paid a percentage of your credit is the wrong person to ask whether you qualify for it or not. Here's what the law actually says. The credit lives in Section 41 of the IRS Code, and the exclusions are the important part. 4 of them land directly on how agencies work. 1. Funded research. If somebody else pays for the work and bears the risk, it isn't your research. Your client hired you, your client paid you, and if the project failed, your client still got billed. That's funded and it's excluded. Number 2, adapting something to a particular customer's need. That's the actual statutory language, and that's a fair description of most agency projects. You take an approach that works and you fit it to this client's situation. 3, surveys and studies, market research, audience research, brand studies. They're excluded by name. And 4, research in the social sciences, arts, or humanities. Creative development, copy, design, messaging strategy, all excluded. Read those 4 together and you've described a typical agency engagement almost completely. That's not a documentation problem. You can't paper your way past it. Now the real opportunity, because there is one. The credit is looking for something you built at your own risk that you own. Think about that proprietary tool. The attribution platform you developed because nothing on the market did what you needed. The internal reporting system you funded yourself. The measurement model you built and now license. Nobody paid you to build it. You didn't know it would work and you kept it. That's the profile. You paid, you took the risk, you own the result. We recently had a client receive a real credit of more than $125,000 for 1 year. So this is worth real money when it's real. One caution, if the software is only for internal use, it has to clear a higher bar called the high threshold of innovation. Generally, it's innovative, real economic risk, and not something you could have bought off the shelf. And that's a real test, not a formality. You need to know the difference between 2 things that get blurred together because one of them just expired. The deduction, Section 174. For a few years, you had to spread research costs over 5 years instead of deducting them all at once. The new law fixed that going forward. Domestic research is currently deductible again for tax years starting after 2024. There was also a catch-up election letting smaller businesses go back and grab unamortized amounts from 22 through 2024. That deadline was July 6, 2026. It's gone. If someone is still pitching you that election, they're selling a closed door. The credit, Section 41, separate, still available, and still claimable on amended returns for open years. Remember, deduction and credit are not the same conversation. One compliance note because it affects the effort. Form 6765 has a Section G that asks you to break the credit down by business component. It was optional, but starting with tax years after 25, it's required. There is an exception, and most agencies land inside it. If your qualified research expenses are $1.5 million or less and your average gross receipts are $50 million or less on an original return, you're excused. Still, the direction of travel we're seeing is clear. The IRS wants to see the work. If your agency does client services and nothing else, this credit probably is not yours. And that's not a failure. It means your money is in an entity structure designed correctly. If a vendor tells you your creative team's time qualifies, get a second opinion before you file. You sign the return, they don't. The best outcome of this video is that some of you stopped paying for a study you'd lose on an audit. And a few of you realized you built something real and never claimed it. Book a free tax analysis. We'll tell you which one you are. Let's talk. All right, before you go, if you're an agency owner and you want to keep more of what you make, I've got two things for you. First, grab a copy of my book, The 12 Biggest Tax Mistakes That Cost Agency Owners Thousands. It breaks down the exact mistakes I see every day and how to avoid them. Second, if you want to see what this looks like for your business, get a free tax analysis. We'll take a look at what you're doing now and show you where you might be overpaying. And if this video helped you, make sure you subscribe so you don't miss future strategies on tax planning, cash flow, and building a more profitable agency. I'll see you in the next video.